Hi traders, today's video is trading on leverage, the key do's and don'ts. Okay, in today's video I'm going to cover the following topics, and they are leverage, margin, the power of leverage, and the do's and the don'ts. Now this video is important, so stay with me to the end and listen to the do's and the don'ts when trading on leverage. And introducing myself, my name is Duncan Cooper. I'm a full-time trader and the senior market strategist and trading mentor at ACY Securities. Okay, let's get into the first topic. Okay, so let's discuss leverage when trading the forex market. The forex market is a leveraged financial instrument. Leverage is the ability to control a large amount of money using none or very little of your own money. In Australia, retail clients have access to 30-to-1 leverage. Qualifying wholesale clients in Australia can get up to 500-to-1 leverage. Other countries can be up to 500-to-1 leverage. And non-Australian residents opening an account through ACY Capital Australia can get up to 500-to-1 leverage. Okay, so what does 30-to-1 leverage mean? If you were to buy 100,000 Australian dollars to the US dollar, you would only require 1/30th of the capital amount to take the trade in your trading account. This capital amount is called margin. Okay, let's now discuss margin. If you have an account balance of $10,000, the margin requirement to buy 100,000 Australian dollars to the US dollar would be 100,000 divided by 30, which is $3,333.33. So in this example, 1/30 of your account balance would be allocated to margin. Now the margin amount is always calculated on the trade size and is not based on the account size. If you have an account balance of $10,000 or $100,000, the margin requirement will still be $3,333.33 to trade 100,000 Australian dollars to the US dollar. It is important to understand that your account must always have sufficient funds to cover the margin. And if you don't have sufficient funds to cover the margin, you will get a margin call. And your trading position or positions could get closed out so that your account balance doesn't go into a negative balance. And to put things into context, if you didn't want to use the full 30-to-1 leverage, you could trade no leverage, so trading 1-to-1. Trading $10,000 on a $10,000 account size, the margin requirement would only be $333.33. Trading 2-to-1 leverage, so trading $20,000 on a $10,000 account size, the margin requirement would only be $666.67. And my final point would be, it isn't necessary to trade the full allocated leverage on your trading account. Now the power of leverage is a double-edged sword. Leverage can dramatically amplify your profits, but at the same time, amplify your losses. I know from mentoring many private clients that over-leveraging your account can be disastrous. So let's now get into the do's and don'ts when trading on leverage. Okay, so let's start with the don'ts. And the first don't is don't open too many positions. Traders take too many positions and have too much of their account balance allocated to margin, leaving little or no account balance available to accommodate a drawdown. When a drawdown occurs, trades are then closed out by the broker due to having insufficient funds to cover the margin. This is called a margin call, and it's definitely something you want to avoid. And the second big don't is traders risk too much of their account balance per trade when trading on leverage. Risking 5%, 10%, 20% or more per trade will potentially put your account in a position where you have insufficient funds to cover the margin. If the market has a sudden strong move against you, you'll run the risk of a margin call. And again, this should be avoided. And to finish, here are 3 simple do's that will ensure you never over leverage your account and receive a margin call. So the first one, only risk 2% of your account balance per trade. Second, only have 2 trades open at any one time. And the third, only allocate 50% of your account balance to margin. If you stick to these rules, you'll ensure that you are not over leveraging your account and will avoid large drawdowns and potential margin calls. And to put things into perspective about risk, on a $10,000 account, 2% risk is $200, but you could be more conservative and only risk 0.5%. That way, you're only risking $50, which is a small amount of your account balance. Okay traders, I hope you found this helpful, and I look forward to seeing you in the next video.
Want a real opportunity to improve your trading? Join Duncan Cooper in his free 15-part webinar series designed to help you improve all areas of your trading. Register at the link below.